So that's one kind of inflation, but it's not the kind you need to worry about in your retirement plan. The good news is you don't need to worry about it if you have the right plan. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. Next week, we'll be doing a show about one of the most important concepts in financial planning, and that is investing by contract. But today, we're going to re-examine another one of the most critical issues when it comes to saving for retirement, and that's inflation. I know some of you might be thinking, well, that's obvious. Of course, you need to plan for inflation. However, it is exactly that mindset that makes this topic worth discussing again and again. We'll talk about why underestimating inflation is one of the most common reasons that retirees run out of income. We'll look at today's inflation rate and discuss the impact of inflation on the economy as well as on the financial markets. And finally, we'll say the key to building a financial strategy that prepares you for the impacts of inflation over 30 years or more in retirement. Joining me and my co-host Jeff Small will be Art Hogan. The third, he's the managing director, chief market strategist at National Securities. We'll also talk to Nathan Cox, co-founder of Retirement Income Solutions, a retirement income store located in Murfreesboro, Tennessee. But before we get to our first guest, let's review some of the fundamental facts about the good, the bad, and the ugly of inflation. The textbook definition of inflation is too much money chasing too few goods. In one sense, inflation is seen as good because it's a sign of a healthy, growing economy. It means consumer demand is high and businesses can charge a little bit more because a lot of people have discretionary income to spend, and they're spending it. However, as with most economic principles, there's a delicate balance. When prices rise too quickly or they rise by too much, it can create a backlash. It can spook the stock market and start squeezing out large sections of the population whose incomes can't keep pace with these rising prices. A domino effect can occur, resulting in everything from stagflation to recession. And ultimately, investors always want to see some level of so-called healthy inflation in the economy, so much that when it doesn't occur naturally, they look to the Federal Reserve to try to manufacture it. This has been especially true ever since the Great Recession. In 7 of the last 10 years since then, inflation has run below its normal 2 to 3% annual average. That's one reason the Fed has engaged in historic levels of artificial stimulus over the last decade, namely in the form of suppressed interest rates and quantitative easing, which basically floods the economy with cheap money. As I've explained before, while all the textbooks say that's how you create inflation, it only works if people are actually spending the money, driving up the demand and thus driving up prices. It doesn't work so well if people are using the money to pay down debts and or investing it for the future. And that's largely what's been happening over the last decade or so, resulting in an asset recovery that has far outpaced the true economic recovery. Of course, it's still happening now as the economy struggles to recover from the coronavirus crisis, and many Americans have fresh worries about the future. Whether the Fed will continue to struggle in its effort to stimulate inflation is a subject of much debate. One hedge fund manager has said he foresees inflation possibly hitting 5 or 10% in the next 4 years. Here's the bottom line. Whether naturally occurring or artificially triggered, inflation is a reality in the best and the worst of economic times. The relatively low inflation rates we've had over the last 10 years or so make it especially important for investors to avoid the dangerous trap of complacency and to be sure their retirement plan adequately prepares them for inflation. We'll talk more directly about that coming up in just a moment. We also want to welcome in Art Hogan III, Managing Director and Chief Market Strategist at National Securities. Art, thanks so much for being back on the show here with us today.
Thanks so much for having me.
Unfortunately, my co-host is having technical difficulties, Jeff Small, in his studio. So it's it's going to be the two of us. But that's okay because I've accomplished more in the last 47 months than Jeff has in 47 years. A little political debate humor. It's been so long since we had you on the show, well before the COVID crisis. So tell me, what has surprised you the most about how the markets or the economy has reacted to this, to all the COVID-19 stuff?
Yeah, it's been an amazing year. 2020 will be a year that none of us will soon forget. And I think that the interesting part of this year was we started out with a market that was looking like it really wanted to chug higher. And as you remember, the first couple of months of the years, we were putting in all-time highs almost every other day. And so this is a market that was on very good footing with an economy that was very strong. Unemployment was very low. Expectations for earnings were very high. And then out of the blue, in February and the beginning of March, we realized that this COVID-19 pandemic was going to hit our shores, and we just didn't realize just how much of a change to our lives that was going to be. So we actually had a market that set some records pretty quickly from going from a bull market to a bear market, the fastest we've ever seen that in history. The 40+% drawdown in the S&P 500 happened at record pace. And at the lows of the market around March 23rd, the news was getting worse, not better, but the market, being a forward pricing mechanism, stopped there and started looking ahead. And the most amazing thing to me right now is how confusing that is for everyday people to understand that how can the market be doing better than we are? How can the market be climbing here? And clearly the news we're getting is getting much worse.
In fact, it was around the middle of summer that you actually gave the advice of having your equity portfolio be well balanced and sticking to your long-term plan regarding your investments. So is that still your advice? I mean, that's turned out to be pretty good advice since midsummer, right?
Yeah, it certainly has. It's actually, we've talked about that at the beginning of the year. And one of the things we really stressed, and this continues to be our game plan, is that you want to have, let's say your average portfolio, you and I have a portfolio that's 60-40, and that means 60% of our assets are going into equities, 40% are going into fixed income. And in that equity portion, we really want you to have a barbell approach where on one end of that, you have growth. And that growth can be expressed in many different ways, but it's exposure to those names that have really helped us through this pandemic, those mega cap, fast growing technology names and some of the healthcare names. On the other end of that barbell, we wanted you to have cyclical exposure, economically sensitive cyclical stocks. And then we want you to rebalance that every 2 months. So in a sense, what you're doing is you're investing in what's working now while the pandemic's going on, and you're investing in what's going to work when the pandemic is over. Every 2 months, you're selling those stocks that have done very, very well because they're what's working, and you're investing in the stocks that haven't done it very well to keep that balance. And if you look at that 60-40 portfolio throughout the course of this year, you're far ahead of the S&P 500 in terms of returns. And I think that approach is going to help you throughout next year as well. As we get to the other side of this pandemic, you're going to see that cyclicals are going to get rotated into economically sensitive stocks like the financials and the industrials and the materials. All of those will do better as the economy starts to improve and we have things like a vaccine and better therapeutics.
You know, it's funny, over the last several weeks, you know, it's been a false start when it comes to those cyclicals. We've had some days where the tech stocks drop, the cyclicals make a little bit of a run, and then all of a sudden it goes back to the tech stocks again. So the market is trying to make that rotation. In the minute we have left in this segment, tell us, you know, best guess. I know you really don't know, nobody has a crystal ball, but when do you think that rotation to the cyclical stocks paying off is likely to happen?
My guess is we're going to probably see that pay off as we head into post-election timeframe. Then we'll have some readouts on some of those vaccine candidates. We'll have a vision that the first half of next year will look a whole lot better than the first half of last year. And I think that market being in front of that is going to start to sponsor some of those cyclicals and probably start to pull back on some of those technology stocks that have just been unidirectionally higher over the last 5 months.
Mm-hmm. I have to tell you, you know, I give you a lot of credit. It looks like you're working from home. And all I have to say is that if I had a sofa that comfy and I had to try to get some work done, I don't think I'm man enough to do it. I'd probably be snoozing half the day. So I give you a lot of credit for that. We take a commercial break. Stay with us if you will. We'll be back in a moment. And you stay with us too. We have much more coming up in just a moment on the income generation. We'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
Call 866-710-1749 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-710-1749, online at theretirementIncomestore.com. Diane and her husband dreamed of spending their retirement traveling, but that changed when she became her mother's primary caregiver. Now her day starts before 6 a.m., helping mom often late into the night. It's a stressful job, but Diane wants the best for her mom. Sound familiar? We thought so too. Caregiving can take a toll on your family, but the Retirement Income Store is here to help. Call 1-888-888-4176 to find out how the Retirement Income Store can help you achieve financial empowerment during retirement.
In my book, The Retirement Income Story, I refer to inflation as the hypertension of retirement. That is the silent killer. Now, that may sound a bit melodramatic, but it's based upon experience. I know from 30 years as a financial advisor that underestimating inflation is one of the most common and one of the most costly mistakes that retirees make with their money. It's true of general inflation, but it's especially true of healthcare inflation, which we'll be discussing in just a moment. In terms of day-to-day cost of living expenses, consider this. While inflation has hit below its historic 2 to 3% average in 7 of the last 10 years, in the 10 years prior to that, it fell below the average only twice. Also, in 4 of those years, it topped 3%. In other words, that historical average is actually pretty consistent, and you need to be sure you have enough income each year to offset the increase. If you're using a retirement income strategy based upon growth, where you engineer income by withdrawing principal and therefore have potentially less money each year, generating less income in the future, then inflation attacks you from both sides. Less money coming in the door, plus increasingly higher expenses is a recipe for disaster. Unfortunately, it's also a common occurrence. However, a faulty strategy is only one reason that people get tripped up by inflation after retirement. Sometimes it can happen simply because you're trying to calculate for inflation yourself, or because you have an advisor not capable of taking a 30,000-foot view of retirement. So what do I mean by that? Well, many of you know that I'm a pilot, so I know firsthand there's a tremendous difference in your field of vision depending upon your altitude. Flying at 1,000 feet, for example, you can see about 40 miles ahead. However, at 30,000 feet, you can see over 200 miles ahead, more than 5 times as far. Figuratively speaking, most people, as well as most financial advisors, fly at 1,000 feet. In terms of looking ahead at a 30-year retirement, that means they're really only capable of seeing maybe 5 or 10 years into the future. By contrast, an advisor who specializes in income-based retirement strategies flies at 30,000 feet. Why? Because our business model requires it. That gives us a 200-mile view, or a view of over 30 years. That is the full scope of your retirement. And that's crucial where inflation is concerned, because with living costs rising by 2 to 3% on average every year, think of it this way. In 30 years, the dollars you have saved up now may meet only half of your income needs, or even less. Now, obviously, that's a problem. It's like having a ladder only half the height of the window that you're trying to reach. In other words, your income, your investment income, doesn't just need to be able to meet your living expenses today or 10 years from now. It needs to be able to do it 30 years from now. That challenge is even trickier when you factor in healthcare inflation, which we'll be talking about coming up in just a moment. Right now, it's time to bring back Art Hogan, Managing Director, Chief Market Strategist of National Securities. So Art, if you think that rotation is going to come at some point shortly after the election, then is your best advice that this volatility that we're likely to see over the next month or month and a half or so leading up to the elections, or maybe even leading up to December by the time we find out who the next president is, when all the votes get counted, are you a proponent of buying the dips on this volatility during this lead up to the elections?
Yeah, buying the dips and timing the market's very difficult for the average investor. So if it's your If it's necessarily your job to trade on a daily basis, that's a fine attribute to have, and buying the dips has certainly worked. If you're a long-term investor with long-term investment needs, I would say stay the course. I want you to have a diversified portfolio, and I want you to rebalance. And when you rebalance every couple of months, you're going to sell some of those winners to get that back down to your original level, and you're going to buy some of those losers. And at the end of the day, that's going to give you the right exposure for that rotation into cyclical. So buying the dips if you're a trader, and stay the course, and continue to rebalance if you're a long-term investor.
Oh, good advice. There's a big difference between long-term and trading for sure. So today, of course, on the show, as you know, we're talking about inflation. And a lot of people are worried about inflation because of all the stuff the Federal Reserve is doing in terms of stimulus, printing money. But the reality of it is we had a lot of that also really over the last decade or so in, pretty much the Federal Reserve stood on its head and could be spitting nickels as far as we know, and they still couldn't manufacture inflation. So do you think all of a sudden we're going to start seeing higher rates of inflation, or do you think it's our bigger enemy's deflation potentially in the years to come?
Well, I would tell you this, a pandemic, a global pandemic, is clearly a deflationary event. There's two types of inflation, and one is demand pull, and the other is supply push. And demand pull just means how much demand is there for all of the goods and services around the planet. And right now, there's not a lot. The economic activity is obviously impaired because of the pandemic. So we're in a deflationary pandemic right now, but coming out of that, there's likely to be a burst of economic activity with all the pent-up demand for the goods and services that we couldn't consume while we're at home. So I will tell you the second thing to think about in terms of what could cause inflation. And on the supply side, the causes could be we've gotten more protectionist as a country, and we're seeing that every day with the technology Cold War we're in with China right now. So having to change supply chains and move those around and get things from other places as we continue to battle China over trade, and that's going to have a cost to it. So the supply side could actually start to see some cost. If we're going to be a less globalized or less global economy, that would certainly come with some cost. On the demand side, I certainly think that demand side is going to be impaired until the second half of next year. So that balance between the demand pull and supply push probably is kept pretty well in check. I would suspect, though, that as we work our way into 2022, we might have a vision where things have improved enough and there's enough demand for goods and services and wages start to slowly rise, and that continues to become a self-fulfilling prophecy that, yes, with the full amount of monetary policy globally, there could be a potential for inflation. I just don't think it's the next 12 months. So if you're concerned about inflation, I would say that I would put that concern over here and start thinking about that at the end of next year.
So do you think then there's a bigger threat of continued asset inflation, which is really what we've seen, after the financial crisis? Not so much inflation as we think of it in the textbook sense, but we've seen this asset inflation with real estate costs, with in fact, we're seeing that even now, right, in the real estate market, and we're seeing that now in the stock market rebound. So do you think there's more of a chance of that happening as happened over the last 12 years or so?
Sure. And the assets obviously are going to be inflated in a low interest rate environment because they're the alternative, right? So if you and I need to have a return on our investment dollar and we can't get it if the US 10-year is yielding 70 basis points, we're gonna be willing to pay more, right? So we're gonna be willing to pay a higher multiple for equities. And that's been true for the history of Wall Street. So clearly, if in fact that safety trade or the yield on the US 10-year were more normalized in something like 3 to 5%, which is its historic average over the last 50 years, then equity valuations would have to come down. And there's a ratio there, right? So I think that's one thing. I think real estate's a whole different department of inflation right now. And what's going on in real estate, which is amazing, and the strongest part of the US economy right now, is that there's two populations going after the same product that we don't have enough.
And we have 20 seconds left, Art.
Housing is I think is very robust right now. I don't think those valuations are elevated. We just don't have enough homes in our country.
And I think people are working from home. They want to work from the nicest home they possibly can and enjoy it if they're going to be stuck there. Art, thanks so much. Your home is certainly very nice, that comfy couch. Hope to have you back. And you stay with us. We have more coming up in just a moment right here on The Income Generation. We'll be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 866-853-7209 for your free retirement income kit. Call 866-853-7209 now.
Meet Bob. 10 years ago, he made the shift from investing for growth in the stock market to investing for income. Today, many of his friends are terrified to open their recent statements, but not Bob. Bob is enjoying his retirement, counting his interest and dividends. By investing for income, Bob was able to reduce his exposure to market risk and establish renewable streams of income for retirement. Sound familiar? If not, start with our free retirement income kit by calling 888-888-4176. The Retirement Income Store, where retirees go for income.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
The number one factor that almost always makes retirement more expensive than you ever dreamed is healthcare. To make matters worse, healthcare costs are subject to some of the greatest inflation rates in the country. Since 1948, the cost of medical care has grown at an average annual rate of 5.3%, much higher than the CPI or Consumer Price Index overall. So at nearly 6%, that means medical and healthcare costs are essentially doubling every 12 years. So if a couple in their 50s is budgeting $200,000 today for annual full-time in-home healthcare, by the time they actually need it in their 80s or 90s, that cost could be 4 times as high. It could be $800,000. There are other issues specific to retirement that come into play as well. Let's say right now you have $2 million sitting in an IRA. With that, you calculate you can afford full-time in-home health care for 10 years. Let's face it, pretty much everyone would rather be able to stay in their own home than be forced to go into a nursing home, more so than ever now in the wake of COVID-19. However, even with $2 million, if your investment allocation isn't optimized for generating income, you probably won't have nearly that much by the time you actually need it. And inflation is only one reason. For instance, starting at age 72, the government forces you to start taking required minimum distributions, RMDs, from that IRA and from all your other retirement accounts. If you don't have a strategy to satisfy these RMDs without spending down your principal, your IRA balance could be down to, let's say, $1 million or less by the time you need it for in-home care. When you factor in the rate of healthcare inflation, those 10 years you could have afforded today are now down to maybe 1 year. And after that, a nursing home might be your only option. Unfortunately, this scenario isn't unusual, and it actually happened to my own aunt and uncle. The only reason it didn't was they both passed away before running out of money. However, at the time that they passed in the early 90s, they were, without knowing it, only a few months away from running out of money. It wasn't because they didn't have plenty of money or were reckless with spenders. They were fairly affluent and very responsible. It was simply that they made that all too common mistake of underestimating the effects of inflation, and particularly healthcare inflation on their retirement. They didn't have a strategy based upon a 30,000-foot view, one designed to prioritize their income needs, help protect their source of income, help prepare for all the contingencies, and help grow their portfolio organically through active management. But right now that we got the technology fixed in our Northern Command, our Northern Studio, it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. And as you know, Jeff's also our brand ambassador for our very own retirement income store. And he's the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. Jeff, good to have you back online. Art Hogan missed you. You weren't able to talk to him.
Yeah, I wasn't able to break his chops, but with that introduction, Dave, you always put a smile on my face, so that kind of makes up for it.
Yeah, and I'm sure what also put a smile on your face is probably the comic effect from the debates earlier in the week. I know they did that. They didn't tell me much about either candidate and their position on issues, but it did have some comic effect, did it not?
It did, but what a lost opportunity by both candidates to really announce what it is they stand for. And I don't think anything was gained other than incentivizing people not to vote, as I think what the major effect is on that from the past debate this week. But we really need to see in the next debate, though, what each candidate stands for and what their policies are going to be, because it's the policies they put in place that are going to drive the economy, not their platitudes and name calling and wishful thinking. That's not going to help anybody. Yeah,
absolutely. And one of the policies is, economics. So you're worried about, our topic today, of course, inflation. Everybody's worried about, okay, are we going to start having some inflation? Might it be still subdued like it's been really over the last decade or so? So it's interesting, as you heard, Art Hogan talked about inflation as being maybe an issue starting 2 years out or so. But his answer to it is the stock market. He thinks we're going to have asset inflation, and if the assets go up, when we get this rotation into cyclical stocks, that's a great way to get an inflation hedge. And that's one way to do it, correct?
It is, and that's the old historical way of, how does our money and our savings keep up with inflation? It's always been the S&P 500 has been the number one barometer to exceed for inflation. But after 2000, Dave, that methodology started to show some serious cracks. And it started with the dot-com bust and then the credit crisis in '08. Then we had the long, 10-year bull run, 11-year bull run here since the 2008 crisis. And so, the market's averaged, 7.2% the last 20 years exactly? That works good for money that's sitting there in savings. But had you been pulling out income, you're out of money in the 17th year. So how do you keep up with inflation when your money can't even last as long as you need it to? And so you got, there's a difference in philosophies there, and you and I preach this stuff all the time. So give me your take on that.
Well, it's funny. We always talk about engineering income being the bad approach by using the withdrawal method, staying in the stock market. And I don't mean high dividend stocks. High dividend blue chippy stocks can work for the right retiree. But I mean staying like the S&P 500 where the dividend yield might be slightly less than 2%, taking withdrawals and hoping you don't run out of money. But what people don't realize is when it comes to inflation, counting on the stock market as an inflation hedge is really engineering an inflation hedge, because the stock market was never known as a good inflation hedge. In fact, it usually does poorly during high inflationary periods. But today's generation of investors, our viewers, our listeners that we love so very much, don't really understand that, because the inflation we saw in the 1980s and early 90s was met by a stock market that was really going straight up to the moon. So in getting back to basics, you always talk about creating inflation the old-fashioned way. Talk about that, if you will.
So I think, Dave, what you're referring to really is the fact that, if you want to keep up with inflation, you're going to allow the market to grow, and that means you're going to be riding the ups and downs, but you're going to be reinvesting those dividends from whatever you're harvesting from the stocks or the funds that you buy, and that'll also act as an inflationary hedge as well. Is that what you mean?
You know what I'm talking about. I'm talking about that thing, man. You know that thing, man, right?
Oh, come on, man. Shut up.
A little vicious debate humor. That's right. So yeah, it's you can cross your fingers and toes and hope the market goes up, and maybe 7 out of 10 years it does and gives you that inflation hedge. But you just don't know long term. So you're right. There's different ways to count for inflation. Real estate historically has been a pretty good inflation hedge also, in real estate investment trusts. Because, for example, as you know, Jeff, in our portfolio, some of our real estate investment trusts, they can negotiate higher and higher lease payments. And that higher rental income that gets paid out really comes out to the investors, and that creates an inflation hedge on their income, which is really what they're most concerned about as a retiree, correct?
Well, it really does. And another way to keep up with inflation, Dave, of course, is through things that pay, dividends and interest, bonds and bond-like instruments. You get that consistent rate of income no matter what. And if you can reinvest that before you retire, or if you have more income than you need when you retire, that's another way to keep up with inflation. But you've got to be invested in things that generate interest earnings.
Yep. Amen, my brother. I love it. All right. We need to take a quick commercial break, and we'll be back in just a moment. So you stay with us. We have much more to come right here on The Income Generation. I'm Dave Scranton. I'm with Jeff Small, and we'll be right back. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
Call 866-314-7227 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-314-7227. Online at theretirementincomestore.com.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
Early in the show, I made the point that ultimately, inflation is a reality you can count on in both the best and worst of economic times. By contrast, one thing you can't always count on is the inflation hedge that's supposedly included in your Social Security benefits. Over the last 10 years, the Social Security Administration's annual cost of living adjustment, or COLA, has been zero 3 different times. In all the other years, it's been frequently less than the actual rate of inflation calculated based upon the CPI index. But that's only part of the story. The truth is that in most years, you don't really get a cost of living increase. Why? Because Medicare Part B premium costs increase every year, and they come out of your Social Security benefits. It's kind of like somebody handing you a check with one hand but taking it back with the other. Also, if you're one of the lucky few Americans to still have a traditional defined benefit pension plan, the old-fashioned pension plans, as a source of retirement income, be aware that most of those pensions don't have an inflation hedge built in either. These are just some further examples of why today's topic is so incredibly important. Like most aspects of retirement planning today, the responsibility of preparing for the impact of inflation is all on your shoulders, which is why having the right advisor to help you through this process, I believe, is crucial. Now it's time to bring in my good friend and co-host, Jeff Small, along with another good friend, Nathan Cox, co-founder of Retirement Income Solutions, a retirement income store located right outside of Nashville, Tennessee. Nathan's also the co-host of the Retirement Income Solutions radio show. So Nathan, thanks for being back with us today.
Hey, thanks, Dave. Appreciate you having me.
So you look good there. You got your background, even though people can't see on the radio. You've got your radio microphone that you use there. You're looking all professional today. We love it. So speaking of professional, I know one of the things that you have to do every single day of your life is help our viewers, help our listeners plan for the long-term effects of inflation. So what do you tell them?
Well, you know, in our practice here, what we've noticed is there doesn't seem to be enough education on long-term effects of inflation in general. I think people have been a little spoiled recently with historically low inflation rates. So I really believe that people don't put enough thought and effort into planning. Of course, you know, we've always got clients who are the engineering types or engineering type minds who come in with spreadsheets and inflation calculations and things of that nature, right? But overall, in general, I just don't think there's enough education out there on that subject. I know you do a good job on your show and try to help educate people, and we try to do the same.
Well, inflation is one of those mystery things. You know, since before 2000, Nathan, everybody was using the S&P 500 to index to inflation today. And so why don't you tell us some of the ideas you utilize to make sure that our clients can generate enough income, and if they're lucky enough, you know, get a raise every year with some type of inflationary percentage. So what are some of the mechanisms you use today in your practice to do that?
Well, in general, I mean, the idea of investing for income instead of relying on growth and capital appreciation to develop that income. I call it organically, to develop that income organically that you need or want in retirement, because it's not just about the income that you need. It's about the income that you may want to have, to not have a vast adjustment in your quality of life in your retirement career. So using income generating tools in the investment world, focusing on interest and dividends, will accomplish essentially both of those.
Mm-hmm. What are some of the other hazards that you see when people are planning for retirement in your boots on the ground, real world experience?
The other hazards, well, inflation obviously is one. In our practice here, what Lindsay and I see most often is I think people don't really take the time to think about what retirement looks like. They're busy, right? They're busy working with their career and taking care of their family, and they don't really take enough time to really sit down and think about their goals and what they want to accomplish while they're retired. Another hazard I can see is that, people say, I had a sweet lady in my office not too long ago who came in and she made a comment that kind of stuck with me. She said the 70 is the new 50, right? People are living longer. I think that people, vastly underestimate the length of time that they're going to be retired.
Yeah.
Yeah.
And it allows inflation more time to do more damage.
Exactly.
But I love what you had to say about having your retirement goals, because, if people retire just to get away from a job they don't like anymore and they're moving away from something that's bad, oftentimes they have an unfulfilling retirement. But if people know what retirement means for them in advance and they're moving towards something that's pleasurable, those are the people that, as I'm sure you see it too, that usually have the most fulfilled retirement.
Yeah.
So we can take a quick commercial break. We'll be back in just a minute. You stay with us. We'll be right back here on the Income Generation. Welcome back to Income Generation. I'm David Scranton. I'm here with Jeff Small and Nathan Cox. So Nathan, we just come off a week where we had the first presidential debate. And, are you finding that a lot of people right now are frozen because they're concerned about the outcome of the elections and how it's going to affect their money?
We're starting to see a little bit of that. People seem to be frozen by, some of it's frozen by fear, honestly. It seems like people really just don't know which direction to turn. And watching the debate this week, it seemed to me looked more like a fight ticket than a political debate. But in general, I think that people just really, they don't know what the outcome is going to be. It seems like it's going to be pretty close either way. And, regardless of how, if you want the election to go one way or the other, what it boils down to is I just don't think people know which direction to go. I think they need some guidance.
And what do you tell them when they're concerned about the elections? I mean, this is one of the most divisive, perhaps the most divisive we've seen during our time. But yet, most of the time, the election doesn't change a ton. And people just lost precious opportunity costs, lost interest, lost gains, because they're sitting on their hands, nervous about the election. But this particular time, what are you telling them? Are you telling them to play conservative because of it, or are you discounting the election outcome as something that, for the most part, shouldn't really affect their long-term strategy?
Well, I think if you go back and look at history, I believe that if you look at market trends historically, because of the impacts or the results of presidential elections, I agree with you. I don't really think that it has that much effect on it. It may affect it for a short period of time. I think there's a lot of other different factors that go into that. So I tell my clients, I said, sometimes that obviously not making a decision is making a decision. So if with investments that you need for income, obviously you need to be more conservative and invest those for income. Investments that you can keep in growth and capital appreciation, then you may see some buying opportunities. So you may want to or need to have some money on the sideline to be able to take advantage of those opportunities.
Sure. Good. They're all good points, Nathan. Jeff?
Well, I think, what drives the economy is not politics, it's policy. And unfortunately, there was very little substance during the debate about what policies are going to drive the economy and how do we lift up people now. Because the headlines, Nathan, are, Disney's laying off 28,000 people. The airlines are laying off 30,000. There's a big 10% cut on all payroll for most of the S&P 500 companies. They're laying off people. So we really need to get some substance. So that's really what's scaring people. It's not so much the divisiveness as much as it is the uncertainty in the policies. Wouldn't you agree?
Absolutely. I totally agree. And watching the debate, like you said, there wasn't much substance there. I know there were some questions that seemed like that were asked that just weren't answered. So I think that's fueling that. Like I said, of course, markets obviously don't like uncertainty. Of course, you can't really tell that as of today. I mean, it looks like we had some fairly good economic numbers that have come out this week, or at least better. But, overall, from an economic standpoint, I think that, the virus is definitely taking a toll, and it's going to continue for a while.
It is, but let's do a debate filler since those two couldn't get their act together. So had they asked me what my policy would have been on China, I would have said, well, my policy on China, if I'm President Trump, is made in America, and Joe Biden's policy is made in China. The decision is easy on that basis, right?
That's correct. Yeah, I agree with that.
Dave, what do you think about that? That's pretty harsh.
But Jeff, we don't want to talk about that. I want to talk about your son. Let's talk about your son and his issues, okay? That's more important than letting the American people know what our policies are going to be moving forward as President of the United States. Well, so, Nathan, we've got 1 minute left. Best advice right now for our income generation viewers, our income generation listeners.
Think about, like I said before, think about what retirement looks like. Look for buying opportunities. Best advice is for the money that you need or want for income in your retirement career, invest it appropriately. Get some advice from a good qualified professional to do that.
So satisfy your income needs first, of course, as we do day in and day out. You, myself, Jeff, with the Retirement Income Store. And then the rest of it, once that's satisfied, if we want to get some growth, then we can. But cover the income first. I love it. Nathan, thanks so much for being with us today on the show. Thank you.
Thank you.
And you stay with us. We have more coming up right here on the Income Generation. We'll be right back.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
I'd like to take this opportunity to thank my guests, Art Hogan and Nathan Cox, as well, of course, my good friend and co-host, Jeff Small, for joining me today on the Income Generation. I'd also like to thank you, our new and returning viewers. As we've seen today, for several reasons, inflation is a reality in the best as well as the worst of economic times. And having a retirement plan that adequately prepares you for it is vital. So let's recap some of the keys to achieving that goal. First, avoid the danger of complacency. Even though the inflation rate has been relatively low in the last 10 years, its historic average of 2 to 3% is consistent. And you need to be sure you have sufficient income each and every year to offset that increase. Second, if you're using a misguided retirement income strategy based upon engineering income from growth, in which you would draw from your principal and potentially have less money each year that generates less income the subsequent year, then inflation attacks you from both sides because you have rising expenses and potentially dwindling income. Remember that third, healthcare and medical costs increase at even faster and steeper rate than the general rate of inflation, essentially doubling every 12 years or so. So even if you think you have plenty of money saved now to meet your retirement healthcare needs without the right income-based strategy, inflation is only one factor that can deplete your savings dramatically by the time you need it. And finally, remember there are a variety of ways in which inflation can undermine your goals, and that it's important to have an advisor equipped to take a 30,000-foot view of your retirement. That means one with the knowledge and resources to help you tackle inflation and to meet your goals not just today or not just 5 or 10 years from now, but 30 years or more into the future. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.